More banks are collapsing after the largest bank fail in U.S. history since the Great Recession in 2008. The bank in Silicon Valley, California, known as SVB, Silicon Valley Bank, had to close its doors on March 10, 2023, basically because it ran out of money. Now, it's interesting to know, as of December 31st, 2022, that bank had $175 billion in assets. Wait. What? Yes, 175 billion. This is the second largest bank to collapse in U.S. history, only behind Washington Mutual, which collapsed in 2008, and they had $307 billion in assets. Now, Silicon Valley Bank, it's not new to the banking world. It opened its doors in 1983, so it's 40 years in the business, and it started by two Bank of America managers, Robert Medeiros and Bill Biggerstaff. And they grew a really successful business in the 80s and 90s as the dot-com companies really took off. And SVB was known for its willingness to loan money to companies in those venture stages. And get this, in 2015, Silicon Valley Bank served 65% of the United States startup businesses. Now let's talk about the FDIC, the Federal Depositors Insurance Corporation. They basically insure the money that we the people have in banks. However, they only insure up to $250,000 per depositor, meaning that if you have more than one account with the bank, they add up the total of both accounts and they will insure that up to $250,000. Now, as I'd mentioned, this bank had $175 billion in deposits. And get this, 97.3% of the depositors had over $250,000 in deposits. Yes, only 2.7% of the $175 billion was under the $250,000 FDIC insured limit. So the FDIC sprung into action and quickly created a bank, the National Bank of Santa Clara, to protect such depositors. So those 2.7%, the people that had less than $250,000 in the bank, they would be made whole, meaning that they would get their money back. But what about the others? According to the statement released on March 13, 2023 from the White House and from the President, stated, customers who had deposits in these banks can rest assured, rest assured they'll be protected and they'll have access to these monies as of today. I'm just reading it the way he said it. No losses will be, and this is an important point, no losses will be borne by taxpayers. Let me repeat that. No losses will be borne by taxpayers. Instead, the money will come from the fees that the bank pays into the deposits insured fund. Now, as I'd mentioned, more banks are beginning to be closed. We just heard that a New York City-based bank, Signature Bank, is being forced to close its doors. Regulators said that keeping the bank open could threaten the stability of the entire financial system. Now, it's also important to know that Signature Bank, based out of New York, was the third largest bank in U.S. history to close its doors in 50 years. So the second largest, and 3 days later, the third largest. Now, they're blaming the cause of such failure in Signature Bank because people just basically got scared and frightened and worried and caused panic, and it made people just want to run and pull money out of the bank because they heard of what happened in California. And look, we've seen it before. People get scared, they get concerned, they get worried, and so what do? They start pulling money out. Most of the people that have a lot of money have heard the stories of the dot-com bubbles. You've heard the stories of the savings and loan crash. You've heard the stories of the Great Depression and the recession. And those times were not that long ago. It is to be known that Signature Bank was pretty heavy when it come to real estate lending. However, it recently made a play into the cryptocurrency deposits. Of course, that turned out to be a bad decision when the bottom fell out of crypto, FTX collapsed, and thus the ensuing criminal investigation. But why did the Silicon Valley Bank fail? Why did the 16th largest bank in the United States have to close its doors? I'm glad you asked. Let's begin with bonds. A bond is issued by a corporation or the U.S. government when they want to raise money. Now, when you buy a bond, you're giving money to people, they're issuing you a bond, and they agree to pay you back with interest payments, typically semi-annual, at a set interest rate. Now, the person issuing the bond also agrees to pay you back the face value, aka the amount of money that you bought the bond for. And all of that is spelled out in writing up front when the bond is purchased, and that's called the maturity date of the bond. To put it quite simple, a bond is basically an IOU when someone needs capital, they need money, and you agree to give them money, and they agree to pay you interest for the money, and then at a set determined date and time, they're going to give you your money back. Now, it is important to know that bonds are not like buying stock. When you purchase a bond, you're not buying any sort of interest or ownership in a company. Bonds also fluctuate with the change in interest rates. You see, bonds compete with each other because of the interest they provide to investors. You see, when interest rates go up, investors make more money off a bond because when interest rates go up, so does the interest rate on the bond that they purchased. And so therefore, they're making more money on a bond when the rates are higher. However, that's not the cost of the bond. That's what they call the coupon that's paying the investor. When the rates go down, the bond pays out less, thus the cost of the bond decreases. Now, you can buy and sell bonds, and when you sell a bond, that interest rate that basically the issuer of that bond agreed to give you transfers to the new buyer. So if it's a 3% or 4% interest that they're receiving semi-annually on that bond gets transferred to the new buyer. But how does this affect banks? You see, when interest rates go up, the interest that a person makes on a bond goes up. So when you buy a bond at a higher interest rate, the person issuing that bond is paying you more money in interest. Remember, this is an IOU. You basically loan someone money and they're paying you back interest. And that interest fluctuates based on the interest rate. This means that for over a decade, interest rates were incredibly low. So banks purchased bonds at a low paying rate. They purchase bonds and the money they're receiving back in interest is pretty low. And this means that bonds that were purchased with very low rates are less desirable than if you could purchase a bond that pays a higher rate. So how did all this affect the Silicon Valley Bank? Well, for starters, it had a run on depositors, meaning that a lot of people at the same time started pulling money out of their bank. And that run was caused by a couple of factors. Number one was consumers were concerned after the Silicon Valley Bank took a loss on its stock of $1.8 billion. And just a week prior to that, Silvergate Bank also closed its doors. So as you can imagine, the rumors started. As a result, the bank didn't have enough money to cover that run on the bank. So they had to sell off bonds. Now, these bonds that they owned, they were purchased and seasoned, and they were bought at much lower rates than you could purchase a new bond for today. Because keep in mind, the rate that you get paid on a bond is pretty much equal to the prevailing current interest rates. And in selling off their bonds, they had to do so at a significant loss. So go with me for a second. If you bought a bond for $1,000 at 3% years ago, and that's a seasoned bond, but now you have these people pulling money out of your bank. So you got to go, oh no, I got to get money back into the bank. So we got to sell off the bonds. But to make your bonds more attractive, because keep in mind, bonds today may be paying 5% and yours is only paying you 3%. So to make that bond attractive, you're going to have to sell it for a short. You're going to have to sell it for a short amount. You're going to have to sell it for less than the face value. As a result, you take a hit. You take a loss on the face value of the bond that you purchase. And that is exactly what happened to Silicon Valley Bank. They had to sell off their bonds. They had to come up with the cash. But as a result, they lost over $2 billion. And as simple as it may sound, they didn't have enough money to cover the net.